Welcome everybody back to our webinar series, Learn to Trade the Market. Yeah, my name as always, Stefan Friedrichowski, and I have to thank thanks Argus FX who make that webinar series possible for each of us. So that's a great thing from Argus. Yeah, we have today the 28th of March, 2 o'clock German time, or what is it really called? Middle East Standard Time? I don't know exactly. Middle Europe. No, I get lost in the name of that time. But anyhow, everybody is here. That's fantastic. And there's already an ongoing chat right now here, or some questions and answers from my end. Yeah, so for the one still writing there, now I cannot answer that quickly, those specific questions, but I think you can understand. I'm not really multitasking capable, so talking and writing is always really crazy. But anyhow, so yeah, you know, today is the last one of those webinars because yeah, it's called Learn to Trade the Market, and we have done a lot of steps up to now. It's in total, I think it was about 12 lessons. Yeah, and you see, how can you reach me? Let's call it private or anything. You see on my first slide 2 email addresses, and you can use both of them, of course. Yeah, so if you want to get in touch with me beyond that webinar, no question, no problem, just take those email addresses. Good. Since we talk about trading, I have, as always, to make that remark about risk warning. So you know, when you finally do your trades, you do them, as always, on your own risk, on your own responsibility. But I know that you know that as well. Good. So what's today? Because it's the last one, last webinar, I want to add some additional here, and that is maybe just a short excursus to statistics, but only really a brief one, just that you get to know a little bit about statistics, because statistics and trading are quite close to each other. I know that most of the traders don't want to believe that, or even don't want to accept that trading is, let's call it, applied statistics, but not only in the sense of how to come to trading strategies, but even in a sense looking to a trading account is something like applied statistics. And that is something I want to do today with you together. And finally, of course, we want to wrap up our strategies and even place some additional orders to get, once again, a little bit more practice, especially now since we have that bunch of strategies. So I want once again to show how I use those different strategies in which kind of sequence, and I want to show it live here within that webinar. But before we start, yeah, of course, recap means we look to our trading account here, and yeah, that's one we used, and we have 2 ongoing trades, both in the minus. And let me check about the account history, about some previous trades from last week. And I have to move it downwards here. And today is 28, so we have 2 additional trades being finalized, one at 24th and the other one at 22. Yeah, the first one is simply an expiration. That means there has been a buy stop order on S&P 500, which has been expired. Okay, so that means our breakout scenario was not triggered, so the order was not filled, and on Friday evening the order has been cancelled, and there's another trade, finally a loser trade on gold that has been a short trade on gold. But as always, I mentioned it is as it is, and how to deal with those miners or winners and losers, that is part of the next topic about a little bit statistics about trading. So we don't have any pending order, but we have two ongoing orders, one on Euro Japanese yen, that's a long trade, and another one is a long trade on Australian dollar, Canadian dollar, and yeah, those two are running and based on two different strategies. First one on multiple EMA, and the other one has been our last strategy, which is called lead leg D1 because we entered that trade on a D1 base. So both trades are running, and as always, I don't touch them. I don't move around stop loss nor take profit, so I let them simply running. As always, just already here looking to that overview, that is the overview from lead leg D1. It's always amazing how the different size of my blue boxes here. You see that the Euro Swiss franc is quite huge, although percentage-wise, all the 6 blue boxes have the same size. What does it mean? As always, Euro, Swiss franc, nothing happens at all. So you can simply don't trade that symbol because there are no moves, no movement, and if there are no moves, then that is definitely a symbol I would not even touch, not even look at, because yeah, there's no favorite direction, no bias into any direction, since there's simply nothing happening. Okay, you see that there are other Euro Forex pairs with more activity, but that is part of the second topic here today. So let's go back to my slides, because I want to introduce a little bit about the statistics of trading. And let me first go through my slide, and then I will show you an Excel sheet in order to simulate some things, and simulating trading activities in an account, which is then not a real account, it's only some Excel sheet. Good. The first comment I always make here when I talk about statistics and trading, that trading is statistics. And that's something really important that you should know, that yeah, trading itself is statistics in both aspects. The one aspect is that we have to accept that most of the time our underlyings, they wiggle around and go up and down, and those movements are quite close to what is called in maths random walk. The good thing is it's only close to a random walk and not complete random walk. If it would be just a random walk, those price movements of any underlying, then there would be no chance for any trading. Since it's not a completely random walk, and by the way, that can be shown by statistics, that offers us as a trader our opportunities if we find them. But what I want to deal here today is a little bit more the trading account itself. Is a little bit of applied statistic as well. Or formally speaking, any trading account or the equity curve is nothing else than a so-called time series of individual trading results. Sounds complicated, but it's only the naming. What does it mean? That's exactly what you do. You do a trade. Finally, the trade ends in a profit or maybe in a loss, whatever, and then you do the next trade and so on and so forth. What does it mean? All those trades are added up and they create our equity curve. But each trade can be seen as some statistical event. Of course, what we want to have is that in sum, all our winners are bigger than all our losers in sum. And that should not take too much time. But formally speaking, every trade is an event, and that might reach stop loss or take profit. And even if you apply some more complicated rules like trailing stops or whatever, finally it doesn't change the picture, because there's a time that the trade ends and then there's a result, and that makes the next move within your equity curve. When I talk about trading, I simply analyze a trading account with 3 numbers. And that those 3 numbers are all I need in order to describe that trading account. There are some situations that it might be a little bit more complex, but 99% of all trading accounts can be described simply by those 3 numbers. There are special exceptions when you have to do that kind of statistics a little bit more complex. But anyhow, so the first one, the first number is quite obvious. That's the win rate. So that's the number of winners divided by the number of total trades. So that is often called the win rate. And one mistake hundreds of people are doing is that they use that win rate alone. And you find within the web or newsletters, websites, people telling, hey, I have a strategy with a win rate of 80%. Okay, that number does not tell you anything, because the win rate itself does not describe a trading account. The number is maybe formally correct, that 80% win rate, that out of 100 trades, 80% are winners and 20% are losers. But that does not tell you that that kind of strategy or that account is profitable. Why? You need definitely 2 additional numbers. And those 2 additional numbers are the average profit and the average loss. Without those 2 numbers, win rate is always completely meaningless. You can have a win rate of 80% and you lose constantly money. Why? Because your winners are that small and your losers are that huge that finally your equity goes south, even with a win rate of 80%. So that's completely misleading. And the same is true vice versa. If you have a win rate of maybe only 20%, you might be the king if your winners are much bigger than your average loss. then even with a win rate of 20%, you might be great in trading. So to describe a trading account, you always need those three numbers. And there must be some statistics behind. So you cannot describe with that concept a trading account with in total 10 trades, because that's not a real statistic. But anyhow, having those three numbers, win rate, average profit, and average loss, then you can describe that strategy even with a so-called expectation value or Erwartungswert. That is a wording from German, and in physics at least even the German word is used in foreign languages as well. But anyhow, so that expectation value is the average expected outcome of a trade, and that can be calculated quite easily. That is win rate times average profit plus 1 minus win rate times average loss. And that number should be bigger than 0. Then finally your equity curve goes to the north. I will show you some examples about that kind of concept, and that will bring some light into any trading activity like we do already here within our webinar series. I'm not 100% sure, but for example, I think we have made maybe 20 trades up to now. And yeah, that is not a real statistics, but that will be shown on within the Excel sheet. Before going to that Excel sheet, I want really to mention the second big thing within trading. Last week I mentioned already that one is discipline. Discipline is really hard. Discipline is hard to achieve, but is absolutely needed within trading. And the other thing is simply accepting statistics. I know that we look for trading results and we look for losers, for example, and then we say, oh yeah, if I would have placed my stop loss a little bit more far away, then it would have been a great trade, and so on and so on. But that's not the right way to go. Simply because trading cannot be optimized to a straight line which only goes north. That's absolutely impossible. So we have to accept that there will be winners and losers. And that is hard to accept, and we always think, hey, we can optimize, we can be better. Yeah, in principle I would agree, but still we have to accept that there are losers. And there is no straight line going north, being an equity curve of any trading account. So we have to accept the statistics of trading, and all trades individually are statistical events, and that has to be accepted. Let me show you a little bit more in detail what I mean here. I have here an Excel sheet, and let me first introduce you how I have done that kind of Excel sheet, even if you are not maybe that interested in Excel. Finally, what does an Excel sheet what the Excel sheet is doing is it creates an equity line that is easily be shown, and you can understand that equity here, and in this case it's an account starting at 5,000 euros and doing 1,000 trades. But there are some numbers which describe that equity curve, or better to say, there is an input which creates that equity. And what I have done here is simply I have those numbers like win rate, which currently is set to 50%, then the average win, which is set to 1, the average loss, currently set to -1. And the reason for having numbers here only like +1 and -1 is that normally I think in R, which is the risk unit of trading, but finally every trade has a risk in euro, and I simply use that number which we use within our trading activities. So normally our risk is 50 euros, and that's all. So, and now the Excel sheet is doing the following. It creates a random number. In this case, 0.059, blah, blah, blah. So that number is between 0 and 1. And what I do then is simply I compare that number with my win rate, and if it is below that threshold, the win rate, then I label the trade a winner trade. So therefore it gets a 1. And otherwise I label the trade with a -1. Finally, I multiply the result with my risk in euro, and therefore we have always trades, in this case up to now, finally ending at plus or minus 50 euros, and those are added up and create my equity. What I can do now, I can do several steps. One is, for example, I can simply press F9, and I get a new sequence of random numbers, and they create me a new sequence for my trading account. And you see, I only pressed F9, so I get a new sequence of random numbers, and that creates a new equity line. And now, wow, that equity goes below 3,000 euros. How can that happen, even after 1,000 trades? Oh, sorry. Hopefully next time when I cough, I can mute my micro before. But anyhow, just a second. Sorry, now I'm back. So I have here one additional number, and that is the expectation value as introduced already on my slide. And for those numbers, win rate 50%, average win +1, average loss -1, of course the expected value of a single trade is simply 0. So that means after 1,000 trades, my account should still be at 5,000 euros. But now look back to the line here. So this line ends nearly at 2,500. What's the reason? Wrong statistics, wrong Excel sheet? No, that's simply statistics. Let me press F9 once again. Well, now we have a result simply within in line with the expected value of 5,000 euros. So after 1,000 trades, we are still at 5,000 euros. And you see, whenever I press F9, we get a new one, sometimes going up, then going down, and so on and so forth. And maybe there's a good one, which after 500 trades have been already at 7,000. What I would like to do here, or what I would show you, we know exactly, because that's the input of that Excel sheet, we know exactly win rate, average loss, average win. And you see how strange, how different those equities can be. And that's something we have to accept. Let me turn the picture a little bit more into the strategies we have introduced during that webinar series. So in most cases, we trade with a risk-reward ratio of about 3. By the way, that would be a nice equity line here. But we cannot expect a win rate of 50%. Definitely no. just a second. Okay, no, now I can go on. So, so we have typically a risk-reward ratio of 3, and but then we can reach a win rate of 50%. Let me first go for the number 25% win rate with risk-reward ratio of 3, and all the trades either end at +3 or -1. You can clearly see that the expectation value of that strategy or those numbers is once again a 0. What is expected because of those numbers. And what we realize, or what can be shown mathematically, that how far away we go here now from our expectation value is now a little bit higher. And that has to do with the risk-reward ratio of 3. But you see once again, okay, that would be a great result. Even, you still have to be in mind that the expectation value is 0. So, but nevertheless, that could be an outcome of that kind of strategy. Once again, pressing F9 shows you some other results. But now the critical part. Let me change the win rate to 27. Now, just from the input numbers here, we have an expectation value of 4 euro per trade. So that means after 1,000 trades, our account should be 9,000 euro. And you see, in this case, yeah, we are close. And back to the input numbers. Think about that you know about, or for your strategy, that on a long run, those numbers are correct and you can achieve those numbers on a long run. But now the critical point. Let me press F9 once again. And maybe once again, I need a specific example here. Just to show you what might happen. So let's take this one here. And now let's really go through that equity here. So we start at 5,000. And first we go south, then a little bit up and so on. Then after maybe 20 trades, we are at 5,500. We think, wow, good, great strategy. We should go on. And then we get a losing sequence like this one here. And maybe we get nervous. The good thing is, if we accept statistics and we know that on a long run we should be profitable, then it's a good time to go on. And finally, you see after 1,000 trades, great result. Let me press F9 once again. Maybe you can find an even more impressive example. Maybe like this one. Because look, after nearly 500 trades, we are still exactly at starting point. We are still at 5,000 euros. We have done 500 trades. So we might get crazy because we know we have a good strategy, but even after 500 trades, we don't see any profit. In between, there have been some profits of more than 1,000 euro, but on the other side, we nearly lost 1,000 euro. So that is something I can only recommend, that you have a feeling for your values, win rate, average loss, average win, and you simply simulate those kind of equities. And that's the reason why I present that Excel sheet here. I have done a little bit more just in order to illustrate how complicated it might be. Let me first describe what is within that Excel sheet. We have the same numbers like in my previous one. So win rate 27%, so a little bit above what's needed for break even. We have an average profit of 3 and an average loss of -1. And what you can see here are simply 100 equities, each of them following some statistics, each of them applying those 3 numbers. But you see how different those results can be. You see a huge deviation, and now this is in units of R, or so you can multiply everything with 50 euros if you want to have the same scale in euros like the previous graph. You see that, yeah, in average, everything goes north. That's fine. But you see, there are a few equities even being in loss after 1,000 trades. And if you just look a little bit to the right-hand picture here in the middle, you see 3 lines or 3 colors. The blue line is a true average of all. And the other one in red and yellow and green, they create what I sometimes call a channel. That's not a real trading channel, but that's an expectation channel for my trading. And applying this kind of statistic means that finally my account should be with some confidence level within those, for example, green lines, blue line, yellow lines, and red lines. For example, if you want to have a 95% confidence level, then you are between those 2 yellow lines. And even after 1,000 trades, you might still be not profitable. So that's really what I call applied statistics, but it's only an Excel sheet with an input of win rate, average win, and average loss, and nothing more. So that's all. So why do I show that? I show that exactly because we have our own trading results, our own time series of equity, and always you ask yourself, should I stop? Is the strategy profitable? Yes or no? And it's really hard to tell. And only if you do something similar like this one here, then you are right, or then you can really judge what's needed here. So it's interesting. And by the way, if you want to have those Excel sheets, once again, you can have them. Just send me an email. Finally, just that you know what's in the Excel sheet as well, I calculate something like what is called the risk of ruin. So going back here to our strategy with 27%, an account starting at 5,000, then in most cases there we should never be ruined, so our equity line should not touch the 0. But for example, if I go 1% less with my win rate, then still I know I have a profitable strategy, but there's some risk of ruin even for that one here. So that's finally what I want to share here with you. And I hope that this gives you a little bit more insight in statistics and statistics of your trading, what you are doing. Don't misunderstand me here. I don't say, okay, losers are loser trades, the next one, the next one, and the next one. So you can do whatever, and finally everything goes north. No, that's not my statement. My statement here is simply, hey, look for your own statistic and compare it with those for example, simulated equity curves. So that's all I want to tell you here. And and it's quite important that you know your statistics and you analyze your own trading activities. But now back to some trading practice. Sorry, my voice is getting down, but anyhow, I will try the best here. That we quickly go through what we normally do when we want to trade, and we go through our sequence. And what is the sequence? Just let me highlight how my sequence is always when I go for trading activities like this one here. We start with a weekly breakout, and then go for multiple EMA first, D1, and then turn to H4. And finally to the lead leg, D1, and then to H4. You know that kind of sequence, you know the trading setups, and yeah, let's get practice here as well. So we go back here to our trading account, and since we always want to start with the weekly breakout scenario, oh no, that was the wrong button. We want to start with weekly, and that means we have that chart here, overview W1, and then we can quickly look what are the right opportunities. And you know, we always compare the previous candle, the previous weekly candle, with a slow EMA. In this case, for S&P 500, that EMA is here down. And so what does it mean? We only would open a long trade, and we would open that trade exactly where my cursor is here right now. So yeah, it's quite far away. So maybe that's not the best chance to look at. So let me skip that. There might be an opportunity in the DAX, the Germany 30, but since I know the numbers here, if you compare high and low, then the range is about 160 points, and that would finally mean that our risk would be too high. At maybe on the edge, 1/3 of that is about 50 euros. So maybe it would be possible to have a DAX trade on that scenario. Let me turn to gold, and gold, yeah, is quite on the edge. So previous candle is completely below that EMA. So short scenario would be a short trade on the low. So we are far away. So no real trading chance here. Brent doesn't look that bad because we are above EMA, and we have the previous candle here, and therefore this is a trading opportunity for us. We want to open a long trade because we are above the EMA, and the long trade should start at 52.054, and the low of the candle is at 49577, and those are the right numbers for our Excel sheet, but I don't have it open, so just a second. So now I have it, and we can calculate the other values. So we need the high of the candle, that is this one here. Oh my God, 52, oh, now I have it, 49577, So, and you know that we place a stop loss just 1/3 from our total range of the previous weekly candle. We want to open a long trade, and then our stop loss should be at 51236, and that's the one we place our stop loss. That means now we can calculate our trade. First, as always, contract size is 100. We need the dollar exchange rate, which is, as we speak, about 1085. Okay, 1085, because Brent is in US dollar. Our entry is 520, this one, and stop loss is 51.236. Risk reward ratio of 3 is okay for that setup, and the lot size is 0.66. Stop loss we know. Take profit is 54508. That's all we need for our trade. It's a long trade, so long trade on oil always costs swaps. So we have to look into the chart. That's the take profit is at 5.4 something. So yeah, that's still within what we can reach in reasonable time. So therefore, it's a good thing to have a trade here being placed. So let me place it trade new order. So lot size was 0.66. Once again, 0.66. Okay. The comment is breakout W1 and stop loss is fixed because we use the scenario with the calculated stop loss out of the previous weekly candle, and we don't want to open the trade market. It should be a pending order. And that pending order should be a buy stop order because we only want to trade to the north direction. So buy stop. And we use an expire date here, and that goes always for Friday. Okay, so the trade should be activated at 52.054, and stop loss is at 49.577, and take profit at 54.508. So those are the right numbers. And let me check lot size once again. Everything is correctly. Looks good, so I can place that order. So no, there's something wrong. You see, I placed the wrong stop loss, but I can correct for the stop loss. Sorry for that. So I used you can see it in the chart that I have used the low for the stop loss and not the real stop loss, 51.236, and that can be modified. And now I hope everything is all right. So now it looks like 1/3, perfect. Mouse over functionality to have a look to the risk. It's correct, it's about 50 euros. That's good. And you see that the take profit is in reach, at least in principle. So this looks quite well. Good. Let me check here for Euro, US dollar, and all those I only want to mention that you know what I'm looking for when I place orders like that, or if I look for trading opportunities here. And that would be south, so we are really far away, so no chance really. US dollar, Japanese yen, that is should be a trade to the north, so even that trade is really far away, and so it's no hurry to even place that order, and might even not possible to have finally a trade there. So Euro, Japanese yen, you see that we have a running trade, and since there's already one trade running, I don't want to place an additional order there. And British pound, US dollar should be a trade to the south. And here, am I right with south? I hope so. Let me look where the EMA is. Yeah, there it is. So therefore, we can place any trade there. Okay, so that's the one setup. That's a weekly breakout, and now we can switch our scenario, and the next one is always the multiple EMA, and that is another profile, and we start with D1, and as you know, we get quite fast our view on that, where it might be possible to open a trade. We always start at S&P 500, and you see, at least during our last couple of webinars, during the last 3 months, now slowly those 3 EMAs constrict, but still there's no real constriction. Looking for Germany 30, same story, so no trading opportunity here. So gold might be a chance, because there we have the situation that the 3-4 EMAs are quite close together. But since we can look for other potentials as well, let me first look if something else is even better. So Brent, we have already placed an order there. Euro, US dollar is quite similar to gold, so those we should only open one of those, but overall situation is at least quite similar. A little bit better for gold. So US dollar, Japanese yen, it's on the way that we get our scenario. Same for Euro, Japanese yen, but there's already a trade running. And here in British pound, US dollar, there's maybe in a short time a good situation, maybe in 1 week about, because then we get maybe even more constriction there. So let's look for gold here. So that is definitely a trading opportunity. So, and Brent, by the way, would be the other one, but since there's already an order placed, we don't place an additional order here. So gold would be our choice. Good. Let's go here for a gold trade, and let me zoom here a little bit. The trade finally should go to the north, because the slope of the slowest EMA is going upwards, so that is the preferred trading direction. But of course we need a stop loss, and that stop loss might be, for example, here out of the chart. There's another line. This line is not needed here. Let me delete that one. So what is the price? The price currently is 125.713. Stop loss anticipated to be 123835. Very good. And trade should be a long trade. Let me calculate that trade within our Excel sheet. It's already filled with gold. That is okay. Exchange rate is okay. Entry would be 1257.13. Stop loss 1238.35. Risk is set to 50 euros. We get a lot size of 0.2. Risk reward ratio with the 3 is fine, and that gives a take profit of 131347. That's all we need for that trade. Stop loss we have already, so we can place that order, and that order can be placed market. So that's a new order here. Definitely we need another lot size, 0.02, and comment in this case is multiple EMA underscore what did we do with the stop loss? It was out of the chart, so we use that suffix, and we have a stop loss at a level of 1238.35 and a take profit of 1313.47. Good. Everything is right. That's a market order. So we have to double check the volume once again. Looks good. So I can place the order. Order is placed. Stop loss is right. Our limit of maximum of 50 euros is fulfilled. So that is quite well. So since we don't want to use, we would normally go for H4 with multiple EMA. But once again, what I would like to do here with you, because that might be the most complicated strategy, is the lead leg, D1. And we have had already that kind of picture. And in order to distinguish my 6 pairs here much better, I rescale them in a way that all the blue boxes are of same size, or about same size. And now you see that the euro Swiss franc is really more or less flat compared to all the other ones. And let me check. Yeah, the other ones are not that bad. Maybe this one has to become a little bit smaller as well. And same is about here. So, how does it look now? We look for the strongest and the weakest. So, which one is the one with the best slope or highest slope? So it would be either Euro Canadian dollar or Euro US dollar. Both are possible. So today we decide for Euro US dollar. I think last week we decided for Canadian dollar. And now we look for the weakest, and from what we have here, there are 2 going south. One is Swiss franc, and the other one is Japanese yen. So finally, our trade would be US dollar versus Japanese yen. So that's a trade of choice. So we open a new chart for that symbol. and then we have everything here. So you can see we go for daily, that we have already that one going south, and yeah, as you saw with H4, that was already a quite impressive move here for that symbol. So since that move is already very much in progress, we should do here our trade a little bit different, not going market directly. We should wait a little bit that the price maybe went up to this level here, and that we get filled there. But then, of course, still we need a stop loss for that trade. And that stop loss might be, for example, here. And then we can have a long running trade for that symbol. Let me check the swaps for that symbol for US dollar, Japanese yen, and whether they are positive or negative for a short trade, and that would be a short trade. They are huge negative, so therefore I have to change my scenario a little bit. So I go for a completely different stop loss, because that trade should not run that long. So I change my stop loss to this level here. So if we are triggered, then we don't use that much room or space here. So stop loss should be at 111.93, entry as a buy, a sell limit 111.033, and that is all enough. We need to calculate the trade. We need the exchange rate euro Japanese yen, which is 119.9. So we can switch here to contract size 100,000, 119. I forgot the. It's about this one here. Our entry should be at 111.033. Stop loss at 111.93. Risk is 50 euro. Lot size 0.06. Risk reward ratio 3. Take profit would be 108.342. That's a trade, and we can place it order as well here within the chart directly. So finally, that trade would be here. And since we don't go market, we use pending order. We want to go into the short direction, but only if the price goes first a little bit upwards and our order gets filled there. So the entrance level would be 111.033 and stop loss 111.93, and with a take profit of 108.342. Comment for the trade is lead leg D1, and we set our stop loss out of the chart. Lot size is wrong. Lot size should be 0.06, and now we have everything ready and we can place that order. Oh, sorry, slight mistake. Entry is 111.033, and now we have it. Good. So order is set, it's running, stop loss is set to the right level, everything works. Very good. So that's the kind of trading practice. Finally, what we have done here, and yeah, I hope that you have learned a little bit about trading. And whenever you need some assistance, just send me an email or to either friedrichowski@argosavix.com or stefan@daytradingcampus.de. So both is possible. Both emails will reach me. And I hope that you have learned a little bit during the last 3 months about trading. It was a pleasure for me to have you within that webinar series. Hopefully we see each other sometimes personally, and maybe there will be a chance in the near future. Or you can simply visit other webinars at Argos-Avix. Then there might be a time that we come together once again. So I have to say goodbye. Thank you for attending here those webinars, all your comments. That's really nice to have you here. I wish you always good trades, at least statistically, and now you know what I mean. Have a good time. Bye-bye.